reverse mortgages, new to the industry or just getting into this niche within the industry. So hopefully we'll be able to teach you a bit about what we all do and how we can help you close more loans and ultimately make more money. So thanks again, and I'm going to hand it over to Wendy Peel from Reverse Vision.
Thanks, Josh. Can everybody hear me okay?
Yeah.
We went without the mic, so if you need me to speak up, just yell at me, throw something, do what you need to do. How many in here know anything at all, or I would say 5% or less, about reverse mortgages? 5%. Did I say it? 5%? You know 5% or less about reverse mortgages. So if you know 95% or more about reverse mortgages, raise your hands.
Oh,
90% or more about reverse. Okay, so this is really the basics, and that's what we want to talk about is why are we here? Why is now a good time to talk about it? What's happened in the industry as far as, you know, reputational risk. There's been some new guidelines and changes that's made the product much more attractive. You might have seen some financial planners have been talking about reverse mortgages a little more now. What does that mean? How can you use that in your business? So now's the time. Baby boomers, I think we all know baby boomers are a massive demographic, and we'll talk a little bit more about that as well. It's definitely an improved product. I like this graph mainly because it illustrates the life cycle of home loan products. And a lot of times people, they're very comfortable talking about first-time home buyers. You've got programs for them. People are very comfortable doing that. And the retirement community, or the HECMs, it's just another phase in life. It's not some deep, dark, secret product. It's just a product that fits that phase in life. And when you start thinking of it in that context, it really helps take some of the stigma away from it. So speaking of the stigma, let's talk about the elephant in the room. There's some big changes the last few years that have happened that have made this much more of a mainstream traditional product. So what were some of the problems? Well, too much too fast. What could possibly go wrong when you could take all of the equity out of your house and not really have to be responsible for any of it? Who's going to spend it all? That's never going to happen. They've limited it to lump sum payouts. That's helped that part of one of the issues. You've heard about your spouse. They're left high and dry. They're kicked out of the house. I mean, we have seen those news programs where little ladies were forced to leave their house. They've now put rules in effect to help with non-belonging spouses. Taxes, insurance. There was actually no real guidelines about having to pay taxes and insurance. With the new laws that have happened, you do have to have an assessment, a financial assessment, to see, oh yeah, I can pay my taxes and insurance. Anybody think of that? Okay, so it's recognized as a retirement tool. Talked a little bit about that. If you've seen, how many of you saw NBC Nightly News last week? It was on NBC Nightly News. Reverse mortgages, very mainstream. Some of the best people, economists around, are talking about, wow, does this make sense? Does it make sense in hedging against sequence of return risk and some of the financial planning tools? So this is actually a financial product that goes well beyond your traditional mortgage. Customer engagement. Borrowers must be 62 years of age. They might have a retirement plan in place. They might not have a retirement plan in place. They might want to stay in their home. They might want to actually move to a new home. There's actually HECM programs for moving to a new home. And Josh and Bob will talk a little bit about that. You can get rid of your current loan payment. That's fantastic if you're retired. You could delay Social Security. You know how few people actually delay Social Security. They don't even know that they could do that. And the benefits in delaying Social Security far outweigh the risks of not doing it. I talked about this a little bit before, sequence of returns risk. Over the last 20 years, if you would have had a HECM in place on just the few times that there was a down market and took the money out of your house and not, it was only 3 times it's happened if you look at it. There's three critical years. You actually would have come out almost double the amount of net worth. And I've got some charts that we can show later. But again, there's reasons to do this that make a lot more sense than simply, I need some money out of my house because X, Y, and Z, or I want to go on a vacation. Emergency fund. Another thing about this program that's a little bit different than your traditional mortgage is it encourages you to get the children involved. Now, why is that a good thing? These children could be your actual clients as well. These children are worried about their parents' quality of life. They might be supplementing their parents' income now. And they're going to be thinking about their own retirement plan, so it is a future potential client for this product. So that's kind of a nutshell of what's been going on. I'm going to have Bob Talpas, who is account manager of Reverse Vision, come up here. He's been in your seats. He knows more about this industry than most people that I've ever talked to, and he's going to come up and give you the fun parts of this presentation. So here you go, Bob.
Thank you, Marty. Hi, everybody. So first of all, just a little bit, real briefly about me. My background is I started out in the forward space as a regular conventional forward lender in 1983, and I was a forward conventional lender until about 2008. 20 years producing as an originator, area sales manager, production manager, started my own small company, and as I got older, I thought, you know, I don't want to do any more forward loans, and I decided I wanted to do reverse mortgages, and I went to work for Wells Fargo doing reverse mortgages in 2008, and about 3 years ago, I was working at my desk, and I got a call from a headhunter saying, would you be interested in interviewing for a job with a company called Reverse Vision? I didn't know who they were. I said, sure. I looked like I met all the qualifications. And 3 interviews later, here I am. So that's my background kind of in a nutshell. And when I started out in 1983, I knew nothing about forward lenders. My first day on the job, my boss pulled out a Thomas Brothers, and he drew a circle, and he said, this is your territory. The rate sheets are over there, go get them, and I didn't even know what an appraisal was. It was a disaster. But eventually I worked my way through it. The first question I ever got, and this is the truth, I walked into a real estate office, and I said, hi, can I help you? Bob, help us with such and such. And the realtor said, yeah, I've got a question for you. Do you know where Freddie Mac's at? And I said, this is the truth, I said, I don't know what he looks like. If you tell me what he looks like and I see him, I'll tell him you're looking. Never got any business. And that's the truth. That's the true story. So anyways, this is Reverse Mortgage 101. If you do reverse mortgages, if you've done a lot of them, this is going to bore you. This is the same seminar I would do at real estate groups and when I would do luncheons at a Coco's, which is a kind of like it's a little diner place down in San Diego, and I would have seniors come in, and this is what I would do. So, what exactly is a reverse mortgage? How do they work? Are they complicated? Are they risky? And why should you be originating them? You should be. When you do your first reverse mortgage, you are going to love it. They are so rewarding, they are so beneficial, they're fun, and you will get attached to the people that you work with. You will change lives, and I mean that. So, what is a HECM? A HECM is a reverse mortgage. That's a type of loan that lets homeowners convert a portion of their equity in their home to cash without ever having to make monthly payments. They never, ever, ever will have to make monthly payments. No repayment is required until the borrower no longer lives in the house. Reverse mortgages are insured by HUD, and borrowers are still responsible to pay for property taxes, insurance, and HOA fees. That's a really important thing to know here, and I want to tell you why. Usually when you read the disaster stories about reverse mortgages in newspapers, the little old lady that got kicked out of her house, when you really get down and you look at it, almost all of the times, it's because they didn't pay their taxes. Usually. Not always, but usually. And it's no different than on a forward mortgage. You have to pay your taxes. You have to pay your insurance. Reverse versus forward loans. How is a reverse mortgage different from a regular conventional mortgage? When you are talking to your customers, you want to simplify. Make it as simple and as clear as possible. And the difference is in a conventional mortgage, you make monthly payments. With a reverse mortgage, you receive monthly payments or you receive cash. So forward, you make, reverse, you receive. Are reverse mortgages safe? That's always going to be a question that's going to be asked. And the answer is yes. No matter what happens to the economy, no matter how much money the borrower receives, how long they live in the house, they will never, ever, 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 ever be required to make a mortgage payment. In addition, no matter what happens to the home's value, they will always have guaranteed access to money. That's a question that would come up all the time when you would meet with customers and their siblings. And they would say, well, okay, I'm going to get this property, and then what happens if property values go down? Nothing. The answer is nothing. No matter what happens to the value, they're always going to have access to the money. So, pop quiz. How many seniors turn 62 each day? Anybody got an idea? Ringers. We've got ringers in this group. 10,000. Huge opportunities going forward for anybody that's going to get involved in this space. A little bit more on are they safe? I'm not going to get into the details on this, but HUD made some changes over the last year and a half, 2 years to make reverse mortgages safe. One is financial assessment, the other is HECM 60. HECM 60 simply, without getting again into details, limited the amount of money that a borrower could potentially pull out at a single time. So they didn't pull out all the cash and use it all up. Financial assessment is something that you folks here that are forward lenders are going to think is a breeze. This is something that kind of cracked me up when financial assessment first came out, and I'll tell you why. In your space, you deal all day long with partnership returns, K1s, pay stubs, averaging income, Schedule C, look at the depreciation, add it back in, get the ratios to match, yada, yada, yada. All day long, right? Well, on reverse mortgages, when I was doing them, it was real simple. I would ask someone, I would meet with the customer, take the loan application, and I would say, now I need a copy of your social security card and your driver's license. And that was it. The trick question was, who's the name of your insurance company, and who do I contact over to get your insurance policy? I couldn't believe the difference. Well, to make reverse mortgages more safe, and because there were issues with folks that used up all the money and ran into some problems, we now have financial assessment where you will see that now we ask for tax returns. We do earn credit. So you are going to have to gather the kind of information you've been gathering, and then underwriting will take a look at it and make a determination. Do we need to do a set-aside to make sure that the property taxes can be paid going forward? So when it first came out and people were talking about, oh my God, this is so difficult. If you've been doing forward loans, financial assessment's going to be a breeze. But folks, the customers do now have to provide information to show that they can pay their taxes. And by the way, while I'm talking, please jump in with questions. I did a seminar one time at the East County Board of Realtors in South Bay. I had a presentation like this, and I never opened up one slide. I just said, any questions? And by the time the hour had finished, everybody had asked all these questions, and I said, there's nothing else to discuss. So please jump in with any questions that you have. Who actually owns a home? The most commonly asked question, I think, when you meet with someone, or maybe the biggest misconception, is who owns the home if I take a reverse mortgage? And the answer is simple: the borrower owns the home. The bank does not own the home. The borrower owns the home. You're also going to see when you do reverse mortgages that a lot of borrowers are going to be taking title or want to have title in a living trust. No big deal. I just noticed when I was in forward loans, everything was individuals, husband and wife joint tenants, that kind of thing. Completely different in reverse mortgages. You'll see a lot of living trusts. But the borrower owns the home. Another question. What happens in the future if the loan exceeds the value of the house? Nothing. The reverse mortgage continues.
So going back to that last question about title and stuff, and how a lot of them want to take title in the trust. I have a lot of scenarios recently where the mom and dad, dad died, mom's still alive, she's still in the house. Then son got on title somehow because everybody wants to be secure in case mom dies. Who knows, But now son's on title, but mom still truly lives in the home. And they're coming to me and like, what can we do about that? I'm like, I don't know, can you plop them back on the title? Can you plop them all back on the title since it's truly her home? She's never...
Those are tough questions. Josh, you take that one.
Sure.
So yeah, you could put mom back on title. You could do something called a life estate where the remainder man would be the son and the mother has life rights to live in the home forever. There's a couple different options there. You do need to be careful with the timing of when you put her back on title. But son would have to, if you're going to place her back on title, son would have to cut off. If he still wanted to retain any kind of property rights, the life estate would be the way to go.
Is there a time, excuse me, is there a time frame that the mom or the parent has to give? Is it for 6 months they have to give?
No. What you want to do is use common sense. You want them at least entitled again for at least 30 days prior to your application. If it's a situation where their spouse is, husband's untitled but wife isn't, that's fine. You can actually put them on at any point. You kind of want to do it before the process of the loan, but you don't even necessarily have to, as long as one of the borrowers is entitled prior to application. So, there's a little bit of gray area there, but the general rule is if they're not currently on title, you want them on title for at least 30 days.
Yes, sir.
There's, if they haven't already got into that situation, there's a new deed out, isn't there now, a transfer on death?
Those are called springing type of deeds, and they're generally not allowable by law.
They're not allowable.
Right.
Anything else?
I got a
Yes, sir.
maximum loan, like an FHA, is 625, 500.
Yes.
But I've seen on title deeds that it's been reported as like $938,000.
Yeah.
Why is
So
that?
the mortgage lien on title is recorded at 1.5 times the maximum claim amount, which would be your appraised value or the FHA maximum of 625.5. And the reason they do that is because it's a negative amortizing loan. They're just leaving room there.
Okay.
I have another scenario. I had a customer where the dad never qualified for the loan, so he could never buy the home in his name. So the daughter took all his money, used it, put it down, but the dad's been living there, has owned the home, pays all the bills, everything's in his name, but the title and the mortgage is in her name because he can't qualify.
Right, so the situation for that, if you would want to put him on title, daughter could come off at closing. If he still can't qualify with the financial assessment restrictions, then obviously there's something we would have to look at that offline a little bit closer. The one very important thing that you need to watch out for that is that it can't be confused as a bailout. That they have consistently paid their taxes and insurance on time, they're not delinquent on their mortgage. You want to make sure it's a solid deal so that red flags aren't raised. Yep. So yeah, you would just make sure that dad's on title before you take the app, and just put all your ducks in a row there.
Got it. Okay, to continue. What happens in the future if the loan exceeds the value of the home? Nothing. The reverse mortgage will continue. Just to add a little bit more color to this, for those of you that don't know, a reverse mortgage line of credit is a negatively amortizing loan. And the way I would explain it to customers, to really simplify it, is I would explain to them, they would always say, I don't get it, what do you mean? I would say, well, the loan's going to slowly grow in time. And they would say, well, I don't get it, what do you mean? And I would say, the best way to explain this, and the best way to understand this, is think in terms of if you had an equity line and you were going to make payments. You had an equity line for $100,000 at 4%, you should be making payments of X amount of dollars a month. Call it $300 a month. On a reverse mortgage, that $300 is going to get added to the loan amount. So the payments that you should have been making, you are not going to be making. So you'll slowly see on a line of credit the loan grow over time, or the balance will slowly grow over time. The good news is on the line of credit, the value of the line of credit also will slowly increase over time. Think in terms of a credit card that you get, and each year the credit card will send you an announcement saying, hey, we've just raised your limit another $4,000 on your credit card. Same principle on the line of credit. So the balance grows, but the available amount of money grows. Okay? And there's formulas that they use. No need to get into that now, but understand that concept. That's one of the beauties about the line of credit. I used to love a line of credit, and that's what I never tried to sell any type of a specific program. I would lay out the choices on the line of credit. I would lay out the choices on the fixed. I would paint it objectively to the borrower, but it seemed like my customers always chose line of credit. Yes, sir.
Does that happen regardless of, like you said, if the value of the home is less than the amount of the loan?
Yep.
It continues to grow
Yep.
based on the formula?
Yep. What happens if the borrower uses up all the money? I used to love this question. I would be sitting and they'd say, what happens if I use up all the money? And I would just look at my customer and I would say, nothing. And I'd pause and there would be kind of dead silence. And they'd say that again. What do you mean? What happens if I use up all the money? Nothing. You've just used up all the money. Nothing happens. I can't be more clear than that. Nothing happens. Now, remember on the line of credit, if they use up all the money on the line of credit, that will slowly grow and they'll have access to more funds. But if they pull out all the money and they use it all up, nothing happens. They just used up all the money. They don't get kicked out of the house. Nothing bad happens. They continue to live in the home. What happens if the borrower is upside down when they sell the house? They can never own more than the value of the house at time of sale. Why? Because these loans are insured by HUD. HUD picks up the negative difference. So part of the mortgage insurance ensures that if someone gets a reverse mortgage and the value of the house when they sell the reverse mortgage is, when they sell the house, is $400,000 and the balance on the reverse mortgage is $420,000 because the property's values dramatically dropped and the loan kept going up and they've got a $420,000 loan and a $400,000 house, HUD picks up the $20,000 difference. So you can't be upside down and close. About two quick questions.
Would that be considered like a deficiency for HUD? And since they get out a claim, would that mean like they're forbidden from getting?
A little more in depth for, yeah.
It is cause for an insurance claim to be filed. Whether or not it negatively impacts you on the Cabers alert, I would have to check. But it definitely causes an insurance claim to be notified.
It seems like it might be classified as a short sale.
Or,
I mean, at the end of the day, it's still a non-recourse loan. So
Right.
the impact to the homeowner,
right,
borrower, I guess, there shouldn't be any at all.
right. They
That
shouldn't
is the
show
bottom line.
up on the Cabers alert system, but we can check for sure.
Okay, so what about realtor fees? How are those paid?
Upon sale of the house,
Correct.
after disposition in this kind of
It's
situation.
upside down, the old 500,000.
Yeah, HUD would work on that. So essentially at that point, it would go back to HUD. They would take the property back, they would deal with disposition, sale, and essentially if it becomes one of their portfolio, REO.
I'm saying if they want to sell the property, and it's what you just
So
said.
so when they sell it, it's a transfer, it's up to the servicer. You're going to be working with the servicer on what's an allowable contract, what's an allowable purchase price, or anything like that. And usually realtor fees are included within, right.
So it's a short sale.
Sort of.
Technically,
It's
it's a short sale.
It's not going to show up as a short sale in that case, like on a forward loan because of the way that they're structured. But does cause an insurance claim through the HUD insurance fund to be filed.
Question? This is a real one-on-one question. Is that something like they're going to show up on the client's credit report?
No. Reverse mortgages currently are not reported to reporting agencies because you're not required to make a mandatory payment.
Okay.
Yes.
Now, let's just say that the house, we sell the house, right? What about taxes? Because now, they have owned the house for now 20 years with a reverse, and now we have all those taxes being paid by a buyer. Okay? Who takes the tax benefit from
You mean on a gain?
that? On the interest.
Of the interest.
Interest is being paid, right?
So who
Okay,
gets
let's
the
just say
1098 deduction?
I'm selling my mom's house, right?
Right.
And now I have the house, I sell it, all that interest is being paid, now who has the right?
I think he means
That-
upon death.
Yeah,
Death
that,
of the original.
Believe
they would be.
anyone does.
Right.
I don't believe anyone does. I can double check that
Well,
myself.
it's deferred interest, so.
Right,
Yeah,
but it's
but
being
it's
paid off.
in
Yeah,
the
I
name
don't-
of your borrower, not necessarily, so there's a few things that can happen when you're going to sell a home. Either you're the borrower selling the home and you pay it off and it's closed, or you're an estate, the heirs or whatever. So we could check into it, but I don't believe that you're going to get the write-off on that.
Well, let's just say that
Sold.
you are the borrower.
I'll tell you the answer that I got asking that question. Always prefaced by the fact that I'm not a CPA.
Right.
tax
Yeah, we always tell everybody to contact your
Disclaimer.
CPA.
I have talked to tax people about it, and the answer I'm getting is whoever pays off a loan is
Gets
entitled to
benefit.
the interest deduction.
Okay.
So if I sell my house, pay off loan to the borrower, I take the interest deduction, that's after fees are paid off and after principal's paid off, et cetera. If my estate pays it or my son pays it because he inherits the property, he can take the write-off,
Okay.
which is a
Yeah, it's
fantastic
definitely
selling
a tax
benefit.
advisor question.
I mean, that's a great selling benefit in selling a loan, is you're creating tax write-off for your end.
Yes, sir.
I was just gonna, I'd add to that, you know, first with a disclaimer that he made, of course, but I just saw something, I think it was in a little webinar that I did the other day. There are some borrowers who would, you know, don't want the principal and the loan amount to grow, and they are making payments.
Sure.
So when they do that, they in effect are paying interest.
Right.
And it's my understanding that there is some limit that once they exceed, they are allowed to take the tax write-off.
Right.
Well,
So
the
that-
interest only owned, so if the interest only, that would be a tax.
Yeah, and that may very well be, but again, broad picture, I never once gave tax advice to a client.
Yeah, that's our
Ever,
standard.
ever. I always told them what I know and what I don't know, and I would say, if you have tax questions, you gotta go talk to a tax expert. I'm just gonna tell you how it works. Yes, sir.
So it's deferred interest, so that means that a borrower doesn't get a 1098 INT.
Right, right, unless they make, there are certain rules, that if they make a certain amount of payments throughout, they have to make a certain amount of payments per year. If the servicer could explain that to you, if they make payments and they actually get to paying off the deferred interest, then they would get one, but since they're not required, they're not going to get one at the end of the year at all, unless they've made enough
Got it.
to the servicer.
Okay, to continue. HUD picks up the negative difference. Pop quiz number 2. Where is the worst place to look for potential borrowers for a reverse mortgage? The worst place. Existing prospects and clients, parents of the existing forward mortgage, local community center, Lady Gaga.
There you go.
Apartments. Renters.
Renters, yeah. Who is eligible for a reverse mortgage? Homeowners, has to be your primary residence. You have to be 62 years of age or older. What properties are eligible for a reverse mortgage? Single-family homes, FHA-approved condos, 2 to 4 unit properties. You'll get into weird properties. Every now and then we'll ask you about the mobile home, if it's a secure foundation, et cetera, et cetera. But this is the basic guideline. Single-family, FHA-approved, 2 to 4 unit properties. One quick thing I want to make sure that everybody's very careful with, and I'm sure you already are. When you get a referral or a lead, or you want to take a loan application on a condo, make sure it's approved before you get into the weeds on it. I cannot tell you. And you can go ahead, when I did reverse mortgages, we did spot approval, so it was kind of a piece of cake if it met all of the parameters of the 51% owner occupancy and whatnot. But boy, check and make sure that condo project's approved.
Are you talking about an FHA approved condo?
Yep.
Okay, so the FHA guy.
Yep, yep.
might have to do-
Exactly.
Okay.
Check with HUD. And also, I would always put it on the property management company. I'd always tell the borrower, please check with the property management company, so they own some of it too. But of course, I'd go to the website and check it. It's published, but still, be careful. What types of reverse mortgages loan are available? Basically 2, fixed rate and the line of credit. That's it. Fixed rate is given to you in a lump sum. Line of credit can be worked out many different ways. The borrower can pull out a specific amount, say $1,000 a month, for the next 2 years and leave the rest in the line of credit and pull it out as they use it. They can customize it to use it as they need it. How much can be borrowed? Lending factors are based on 3 things, basically. The age of the youngest borrower, the appraised value of the house, and the expected interest rate. And I would get the expected interest rate question a lot where people would say, what's this? What's the expected interest rate? And the way it was taught to me when I went through training in Wells Fargo, and the way I will convey it to you right now, is you take those 3 things, the age of the youngest borrower, the value of the home, the appraised value, and the expected interest rate, which is a rate that is used by the lender to determine how much the borrower can borrow. It's only used once. It's nothing that continues. The borrower doesn't deal with the expected interest rate going forward. Those 3 ingredients are put into a pot, they're blended up, you push a button and it spits out a number. You're eligible for $225,000. So it's a real simple formula that's used to determine how much they can be borrowed. Pop quiz number 3, a borrower's property. This is kind of a double negative. A borrower's property cannot be in need of home repairs when they get a reverse mortgage. True or false?
True.
The answer is that a borrower's property can be in need of home repairs when you get a reverse mortgage. So for instance, if something needs to be done with a roof, That would not be something that would preclude a borrower from moving forward with a reverse mortgage. There would simply be a set aside based on a specific formula. That would be withheld until the roof is completed, the roof work is completed, notice of completion is sent in, and the money is released. So a home can be in need of repairs, and it's actually pretty common. I did a couple loans for hoarders, and all the stuff had to be cleared out because it was a safety issue. And we went ahead and did the loan, but they had to go ahead and get all that stuff out. So you're going to run into all kinds of different scenarios.
Now, that's not including purchase, right?
Correct, with the purchase, it has to be fully complete, and any kind of repair has to be handled by the seller prior to closing. You
Yeah.
can't do a repair set aside on.
Yeah, good question and good comment. I'm talking refi. So can someone buy a home using a reverse mortgage? Absolutely, the answer yes. This is one way that you're going to grow your business. This will give you an opportunity to stand up in front of real estate groups and talk about HECM for purchase. You will find when you speak in front of real estate groups for HECM for purchase, you will often not get any HECM for purchase loans from realtors. But what you will get is inquiries for their own personal reverse mortgages, or they all have a boatload of customers that they did a loan for 20 years ago, and someone needs a reverse mortgage and now they're going to call you. So when you want to get in front of a real estate office, talking about HECM for purchase is a fantastic way to grow your business. Believe me, it will open up numerous and multiple conversations. Are there counseling requirements? This is a positive. The answer, of course, is yes. As a pre-application requirement, all borrowers need to get counseled through a HUD-approved counseling agency. The counseling can be completed over the phone or in person. Most of the time it's completed over the phone. Family members are encouraged to participate. When you meet with the customer, and if the kids aren't there, and you're just meeting with the husband and the wife, or just the wife, or whoever it is, encourage the siblings to get involved in the counseling process. And when you hear customers initially come up with a negative reply to the fact that you've told them that they have to go through counseling, it's a positive. And the way I would explain it to them is I would say, it is for your protection. Because Mr. or Mrs. Borrower, what if during this 45-minute, 1-hour conversation I've missed 2 things? This is where counseling comes in and covers my back. Counseling is independent. It's a third party. They have no interest in whether or not you close a loan. Sure, they hope you do, but they sure don't have any monetary interest in whether or not you close the loan. So you turn it into a positive for them. It's a third party analyzing everything we've said and answering any other questions that you may have. Get the kids involved in counseling. When does a reverse mortgage become due, and what happens when you no longer live in the home, or when you pass away, the reverse mortgage becomes due? The heirs have 2 options. They can pay off the balance of the reverse mortgage with a refinance or other funds. They can sell the home. They have 6 months to do this. And are there still caveats where they can get the extension?
There are extensions you
Yeah.
can apply for,
Yeah.
but the most important thing that you want to tell your customers is that they're communicating with the servicer. They will not start foreclosure proceedings as long as you can actively prove that you're either trying to obtain the financing or sell a home. But you have to stay in communication with your servicer.
Yeah. And it's 6 months with a pretty easy 6-month extension.
No, it's pretty easy, yeah.
Back when I was doing these loans in 2008, it was actually, if I remember correctly, it was a year with a 1-year extension, potentially. So in some instances, people had, yeah, back then it did take a longer time. Some reverse mortgage facts. Reverse mortgage funds are non-taxable. You'll get that question asked a lot. Someone pulls some money out of their house. They don't pay taxes on it. They do not impact Social Security or Medicare. If you get someone to ask you a question about does it impact Medicaid, you punt, and you simply tell them they need to speak to their Medicaid person. This is just I'm going to go off topic a little bit, but I said it previously. Answer the questions that you know and don't be an expert in too much. Be an expert in reverse mortgages. I always stay away from tax questions, from Medicaid questions. I refer them to their local expert. And I think sometimes I don't know if they respected me, but I think they liked and felt comfortable that I would tell them that. These are non-recourse loans. There's no restrictions on how the borrower may use the money. They can use it for whatever purpose they want. They're fun to do. You know, they really, really, really are. You're actually going to be helping someone. And you will also be developing a long-term relationship with a senior and their family. You'll become much more than a loan officer. You're a trusted advisor. When I was a loan officer, I tried to maintain relationships with all my customers, and I often did. But it's different in a reverse mortgage. You almost become a part of the family. And you really, really, really connect with these people. I mean, some of the stories are heartwarming. I'll get to you in just a second. I think one of the last loans I did was for a 98 or a 97-year-old man who was terminal. And he didn't have enough money to pay for home care. And he didn't want to die in a hospital. And I met with him while he was laying in his bed in the living room. We did the reverse mortgage for him. And that kind of stuff really impacts you and moves you. It's good, rewarding stuff. Was there a question?
Yeah, a question for her. Under no restrictions on use of the money, let's just say that somebody wants to get a reverse, to get an annuity.
So there are some gray areas there. They don't want you to use the money to purchase annuities or other retirement
Okay.
insurance things. And if you are, you have to disclose what it's going to be used for. If you do it after the fact, no disclosure.
The kicker is to not have it associated or
Right.
affiliated in any
During
way
the
with this
process.
transaction. That's like the big no-no from HUD.
Right.
Is people used to be bundling it together. They're
That
like,
would-
let's take 100,000, use it directly for the annuity. The lesson would be close your HECM, close it, fund it,
Then go
take a
purchase.
day, sleep on it, and then
Right.
potentially do whatever else you're doing
Right.
after the fact.
The question was, is if they did say yes, that would kill the deal.
It-
I was gonna say, not necessarily.
Not necessarily,
It
but
would
it definitely
certainly
opens up a
complicate
whole new
things.
avenue and red tape that we.
All your county executives.
Yeah.
Yeah,
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 exactly.
executive, and wink, wink, don't do
Yeah.
that.
Right.
Is that a problem with financial planners as far as what they're, I mean, that's
No, I mean,
how
we
as far
actually have
as-
started marketing directly to financial planners and everything, and it's the same conversation, just there are some safeguards and some restrictions that HUD has with them, so you want to make sure that a lot of that happens after.
Yeah, and most FAs, they want to keep it separate, right?
Right.
So
Right.
they like and appreciate that too. We're not trying to commingle transactions and double commissions and triple commissions. We want to keep it separate. A financial advisor appreciates, respects, and really wants that
So
too.
but
So they're like, you
not
do your
really-
thing, and then after that, so if you go to a financial advisor, you might say, look, we're going to work with this borrower. They're going to end up having a line of credit and or taking $100,000 in cash. At that point, that's where you, Mr. or Mrs. Financial Advisor, can come in and then decide how best to use those funds as part of their retirement planning, as part of their sort of broader strategy. Yeah.
Can I add something to that?
Yeah.
You mind? I had a client in January that took out $550,000. And what we did, very simply, was we sent an electronic check to his bank. So the whole $550,000 was deposited into his bank. And about a week later, he took $300,000 and had his financial advisor move it into a different investment. But most of the time, there's no easy check. So you just arrange to have the check deposited in their bank, and then after the fact, what happens is there's no trail.
Yeah, after the fact, there's no real
Yeah,
follow-up
nobody-
on that aspect.
Yeah, because you're not delivering $250,000 checks,
Right.
you know.
What are some typical uses with funds from reverse mortgages? Remodel, update a home, refinance an existing mortgage. That's a biggie. You'll find seniors that will have a mortgage payment of $1,500 a month, $1,600 a month. They have limited income. You take a reverse mortgage, you pay off the first, payment goes away. Little money left over in the bank gives them some breathing room. Buy a home, they can always buy, again, reverse mortgage for purchase. It's a big, big, huge tool. Take a trip, pay for in-home care, remove the stress of trying to make ends meet, and then again, delay retirement, focusing on the fact that not all reverse loans are needs-based. As we move into this next level of reverse mortgages, and as I talk to more and more people, I find that real successful reverse mortgage originators and companies are working with financial planners, showing that reverse mortgages aren't all needs-based. If you go on the Reverse Vision website, and again, I'm with Reverse Vision, reversevision.com, you will be able to find a link with some stories that we tell. Kelly, what's the actual verbiage? It's the director's case studies.
Case studies?
Case studies, yeah. Yeah, so we have, I know. So we have case studies. We actually did somebody did a loan for a owner of a professional sports team up in the Oregon area that was very, very wealthy and just wanted a reverse mortgage as part of a wealth planning strategy. So they aren't all needs-based. A lot of them are. But you're going to find that will happen. More and more will not be needs-based.
Excuse me. Say that one more time. Really for somebody who's owns a professional sports team,
Yeah.
how do they benefit them?
As part of a financial planning strategy. They may have used reverse funds. I'll give you an example. I'm not a financial expert at all. Your portfolio starts dropping down for some reason. Okay? You can use reverse funds when the portfolio is at a lower value to do stuff. And then when your portfolio regains its value, now you can start using the portfolio again, or do it the other way around. You can use your portfolio based on whether it's going up or down in conjunction with a reverse mortgage to maximize the profitability of your portfolio. How this individual did it, I didn't do the loan, so I don't know.
He actually was doing a remodel of his condo for about $1 million, and it was a better financial strategy for him to use the funds out of from a HECM rather than go into his portfolio.
Yeah.
It was that simple. It was simple math.
Because
And
maybe
that's why they made the decision.
Because maybe at the time the portfolio was performing magnificently, you didn't want to pull any money out of it.
I do another business in sports, that's what I was asking.
Oh, yeah. Go to our case study on the website.
I wish.
So they're not all needs-based. Real quickly, sometime you'll hear this. I've never had any customer ask about a reverse mortgage. No reason for me to get involved. There's no need for it. It's true of everything. People weren't asking for Netflix. They weren't asking for ATMs. They weren't asking for smartphones. We gave it to them when they wanted it. We're in the early stage of the wave of baby boomers. A lot of baby boomers that are now 64, 65, born in, say, 1952. 10 years from now, they're going to be in their 70s or less than that, and they're going to be ideal candidates for a reverse mortgage. Plus, we're seeing the ages drop down a little bit where people start getting these loans. So this is the time. Talk to financial planners. Quick myths. Lender owns the home. Absolutely not. Nothing could be farther from the truth. Title stays in the borrower's name. Another myth. Bank gets the home when the borrower dies. Again, not true. The heirs inherit the house, and they have up to 6 or 12 months to pay off the mortgage. The homeowners could get forced out of the house. Absolutely not true, unless they don't pay their taxes. Then eventually they're going to have to leave. Got to pay taxes.
Right, but even in that situation, just so you can tell your customers, we are unlike the forward mortgage. It takes a very long time. They also get them involved in pre-foreclosure counseling through a HECM counselor. It takes a very long time. So when you do see those news stories about little old lady being thrown out, that's probably been going on for a year and a half. It's a long time, so.
And then real quickly about Reverse Vision, we're in San Diego. Been here since 2007. Everybody uses our software. We service and help lenders, brokers, correspondents, and investors. Out of the top 10 lenders in the industry, 9 of them are licensed with Reverse Vision. 150 lenders, 5,000 companies, 20,000 users, over 100 banks, and our lender partners will help you, and this is kind of where I'm going to bow out now. I've given you the broad overview of 101. Wendy told you why you should get into the market. Now I'm going to turn it over to Josh Shine. Oh, quick pop quiz. Which characteristic is not needed to be a successful reverse mortgage loan officer? Patience, empathy, professionalism, good singing voice. Mind your database. Have fun doing these things. They're great loans. Remember, you're not only improving a senior's life, you're also doing business. You're helping with your income. You're making things better for them. They are extremely profitable, and every loan you do will involve a family that has other financial needs, so you're going to be building a relationship. That said, off to them.
Hopefully no food spill in the back there. Thank you, Bob and Wendy. So I just want to do, I know Wendy did a quick survey. I want to do it a little differently. How many of you have closed a reverse mortgage this year? Show of hands. Okay, so a few of you in the room, but nice to see a bunch of you haven't. Hopefully we can help both of you. Just to reiterate what Bob and Wendy were saying, Reverse Vision is the software in the industry. We all use it, incredibly helpful. A lot of tools both on their site, and then once you get into the software, which we as the lender help you, Rochelle, our account executive, Sherry, head of our wholesale, myself, head of reverses at Home Point, I'll get into that in a minute. We help sort of hold your hands using Reverse Vision, but it's super, super easy to use as far as an origination platform to get into reverses and understand some of the numbers and some of the back and forth. So just real briefly on me, been in the business a decent amount of time, a number of years, had my own company for a long time, then took my whole essentially reverse team as I transitioned from all forwards into reverses. I sort of got excited about it. I liked what I saw. I liked where the business was going. I liked working with seniors. Grew a nice team. Came over to Maverick Funding, which was based in New Jersey. Fast forward a number of years, I grew the entire reverse division there, retail and wholesale. And Point Financial, which I'll get into in a minute, took over Maverick, and now I'm with them with our entire reverse team. Point Financial, although a year old, again, took over Maverick, which is about 10 years old. Point Financial is backed by a private equity fund that committed a really significant amount of money to grow the company. Reverse, forward, retail, wholesale, national, coast to coast, offices everywhere, the whole bit. Executive management team from Cole Taylor Bank and a number of other lenders, really seasoned group of people committed to really providing excellent service, excellent follow-up and follow-through, and really becoming a leader on the reverse side, on the forward side, on retail and on wholesale. Okay, we're based in Ann Arbor, Michigan. I'm based in Owings Mills, Maryland, but we have an office here in Newport Beach where Rochelle is based, just a few minutes right down the road. So we went over reverses, and some of you have those. I'm curious, just maybe a few people, if you could jump in, throw out there, why haven't you done a reverse? I'm always curious to hear, is there a specific reason you haven't done it? Is it not knowing enough about it, or is there anything else that is specific that comes up as to why you haven't jumped into reverses yet? Anyone? Okay, well, the biggest reason we hear in talking to people is the software, not understanding how to get into it, used to Encompass, used to Calyx Point, not used to a new software, and then the confusion surrounding it. And as Bob said, a lot of that has changed in recent years. Now it is not that different from a traditional forward mortgage, okay? You're looking at income, you're looking at assets, you're looking at credit. So don't be intimidated by it. Don't try to confuse it, and don't let a potential borrower, a potential prospect, or a referral partner get confused by it, okay? As Bob said, just to take it on a sort of basic overview, it's a mortgage, it's a loan, it's a lien on your home. Don't get confused by the misconceptions, the myths, and sort of the bad stories from the past as to who does own the home, who retains the title, all the scams that might have taken place in the past. That's all been cracked down on. Third-party counseling and some of the recent changes have made it a really good, secure, safe, and really high-quality product for the senior. It really protects their interests and their needs, and it's really not that complicated. So I try to keep it basic. It's a loan, it's a mortgage, you're just not making payments. That's really all it is. Your balance will go up instead of going down. We mentioned some of the media attention. I want to take a minute on that. It's a big deal for us in the reverse niche, in the reverse industry, okay? Mortgages, everyone knows mortgages. Reverses do have some history with them that has been questionable in the past. But in the last year and 18 months, we've had more positive news, and certainly in the past 6 months, than we've had in a long, long time. Great for the industry, great for the opportunity for you to say, now is the time to get into reverses. The NBC News spot, if you haven't seen it, we'll send out some emails afterwards with the link. Outstanding spot on NBC Nightly News, Fox News Channel, I worked with them on some pieces, Wall Street Journal, Kiplinger, great reputable, obviously, personal finance magazine, Financial Advisor magazine. A lot of the FAs are seeing more and more stories and more articles about it. It's really gaining the momentum because it has the protection now on the tax and insurance side by making sure people have an ability to pay. I'll get into that in another second. Oh boy, I broke it. Hold on. What happened here? Hold on. All right, I'm needing technical support here. What do we got here? It's pulling up a different website. Hold on. We're on MSN right now. I didn't even touch this beforehand. There we go. Okay, the new HECM. So one of the things we talk about in the industry a lot is recently is HECM versus reverse mortgage. HECM is home equity conversion mortgage. If you go to FHA's website, okay, and you read about it, there's a lot of reference to HECM, home equity conversion mortgage. I've run into a lot of brokers these days that use that as their pitch, as their new opening to represent the change that has taken place in the last 6, 12, 18 months with the product. The reverse mortgage was of old. The reverse mortgage didn't have as many protections for the spouses. Okay? The reverse mortgage didn't have protections for the lenders and for the borrowers with regards to taxes and insurance. This is now the HECM, the new HECM. It does have those protections. It has instituted all those changes for the spouse, for the taxes and insurance, and to protect the borrower, protect the lenders, protect FHA, HUD, our tax dollars, I guess, at work. So keep that in mind in sitting down with people and sitting down with groups. I have a broker we work with in Florida. He has gotten approved to do some continuing ed for realtors. So he submitted a class that is training realtors on the HECM for purchase. And this is his in to reaching out with regards to HECMs and teaching realtors. And so they get their few hours of CE by sitting and learning about the HECM for purchase. He sits there in the group and he says, how many of you know about a reverse mortgage? Everyone raises their hand. He goes, how many of you have had a good experience or can say something or refer to something positive about a reverse mortgage? Every hand goes down. He then says, how many of you know about a HECM? And no hands go up. So it's a real opening and a real opportunity for him to say, let me tell you about that HECM. Here's what's different about it. Here's why it's improved. Here's why you should be offering it. Bob hit the nail on the head when he said with realtors, you run into a lot of them that do want to end up doing it themselves. It is slowly but surely growing, both the realtor community wanting to do them, but their clients. They are starting to come around. Seniors are buying a lot of homes every year. A recent statistic came out that more than 25% are actually upsizing, okay, seniors in buying a home. And as I saw the statistic, I did think about some people I know who are older. They're saying, you know what, now we're going to spend that money. We're going to enjoy what we want to do, move into a bigger house, a better house, a nicer house. It may not make sense for the space, they may not really need it, but they are actually doing it. And their HECM for purchase gives them the ability to buy more, and that's a big plus. So really a huge opportunity in that marketplace as well. So as I said, more similar than ever to a forward loan. We're checking income, we're checking assets. We're not looking at credit score, okay? It is captured, obviously, when we pull credit, but we don't look at that. But we look at the lates on a mortgage, lates on your taxes, and lates on insurance, sort of put you in, I don't want to say a bad light, but certainly start to put you over to the side a little bit where we're going to have to dig a little deeper with regards to your history of payments, okay? Really good payment history is a major plus. And then we look at capacity and willingness. So I'll just take a few seconds with that. I don't want to dig too deep on underwriting guidelines, but the big test with the financial assessment changes that HUD came forward with is capacity and willingness. Has the borrower exhibited the capacity to make their payments on taxes and insurance? Simply, do they have enough income? Once they've met that income threshold, you stop. So you don't dig deeper on tax returns, you don't go any further into their finances. If Social Security can cover it, if Social Security for one can cover it, if the pension for the wife can cover it, you don't have to add any more income, show any more income, or prove any more income. But you need to be able to show that that income can cover taxes, insurance, a little bit of maintenance, okay? It's 14 cents per square foot based on the home size, and then has enough residual income left based on the region of where you live, similar to VA, for those of you who are familiar with VA guidelines, and how many homeowners are in the home. So we've had people who have, $1,300 in Social Security, live in a small home, generally not in this neck of the woods, but in other parts of the country, they can afford to get approved for the HECM. They meet the threshold for having enough money after paying taxes and insurance and being able to upkeep their home. That's the capacity test. The willingness test. Have they shown, based on their history of the mortgages they made payments on, their taxes, their insurance, and their other credit cards, revolving debt that they had as well, have they shown a willingness to pay their bills on time? Okay? If they have not shown that willingness, we need to understand what happened, what went wrong. Every reverse mortgage is a manual underwriting. I tell our underwriters it's the most difficult product out there to underwrite in the mortgage industry today. There's no desktop underwriting, there's no automated findings, nothing. Every single one, they have to open it up. I say that, but it's on double monitors. Open it up, look at everything, make their determination. There's a lot of gray area here. gray area is good and bad. I like to think it's more good than bad. The underwriters have the discretion to make a decision based on that willingness that they had in the past for making payments on time or not making payments on time. So if you missed a few payments January of this year, but there was what we call an extenuating circumstance, death in the family, loss of job, other extreme event that significantly impacts things, that can be okay. You sort of get a pass in that sense. What does the pass mean? The pass means that we don't have to do a set-aside, life expectancy set-aside, we nicknamed it the LISA in the industry, for your taxes and insurance, okay? So if you meet the willingness test, you don't have to get the set-aside. You will be responsible for making payments for your taxes and insurance on your own for the rest of the time while you're in the home. You will not have to make a mortgage payment, obviously. You can if you wish, interest only, principal and interest, any amount, no amount, but you will make the tax and insurance payments on your own. Yes?
I have a quick question. What's the formula for that LISA set aside?
So,
how much is it?
The technical formula, if you're a math guy, is actually, I can send it to you, it's in the HUD handbook, and it is a crazy, ridiculous, like deep financial formula that has like 6 lines on it. The short story is, it takes, for the most part, the life expectancy, that's set per HUD, again, all HECMs are based on life, right? How long you're gonna live. And looking at your taxes and insurance, adjusting for a little bit of an increase on an annual basis, and bundling it all together. So I had one the other day, taxes and insurance, the LISA ended up being about $53,000. The person was 77. So they're anticipating that that should cover their taxes and insurance for just about the rest of their life. It may not be all of it, but the vast majority of it. So it's a complex formula. That's where we all say, go to reverse vision. Click the button, they'll tell you what it is. You know, we just everything we do, and this is actually a good sort of segue into that, and I want to finish getting on to willingness. We never say to a borrower, a prospect, a broker, a client, anyone, I can give you some basic numbers. It's all, give me date of birth, give me home value and lien balance, and let me put it into RV. You got to put it into reverse vision. We got to crunch those numbers. We don't do anything without crunching those numbers. Those are the HUD mandated numbers as to how much anyone's allowed to borrow, what the set aside may or may not look like, and sort of a breakdown of everything. It's all mandated by HUD. Myself, as one of the top 10 lenders, versus any one of my competitors out there, we're all offering the exact same product. I'm always very open about that. It's the same thing we're selling, okay? They don't have any specific special pricing adjustments. They don't have any specific extra LTV kicker they can give you. It's all the exact same mandated product with the mandated LTVs based on someone's birthday. That's it, it's as simple as that. Where we get a little flexible out there, for us in service, which I'll get to in a little bit, and then there's potential for credits, for someone to get credits as well. But at the end of the day, the HECM is the HECM. Whereas on the forward side, there's some different variations on some arms, and different variations on a 30-year, a 15-year, a lower dock, a more extreme dock, different credit score adjustments. We don't have like any of those kinds of things. Yes?
14 cents a square foot.
Yep.
Is that based upon the appraisal, or is that based upon what the county has on the house?
So, good question. My answer, sure, I'm not sure what you would say, is the two should essentially match.
Yeah, well,
if work was done, improvement was done, renovation was done, and reported, if it wasn't, that could open up an issue within the appraisal for us to sit there and say, well, tax records are showing 1,600, but the appraisal, the guy went out there and it's actually 3,200. They did an add-on and didn't do it legally, that could affect the value, in fact, we're looking at.
But if it was done, if they did have permits, and it was done legally, but it wasn't registered.
It would be the appraised value. It would be, that's
The appraised size.
Yep, correct.
Okay.
Yep, correct. Yes, sir.
Are the HECM appraisals the same in mirror image like HUD, where it's unpermitted square footage, but it's done in a workmanlike manner to get by?
It depends. So most of the appraisals are all done on FHA, they're FHA appraisals, but with the reverse mortgages, it's a little more sensitive to work being done, safety hazards, and those type of things for the seniors. So if you have an unpermitted addition, it was done in a workmanlike manner, FHA might be okay with it, but the local jurisdiction may not. So you could have a conflict there.
Yeah, I mean, those cases, we've gone to local counties, depending on whether it's grandfathered in.
What percent of them?
Well, it depends on the local jurisdiction.
So we had two situations, had a garage renovation
Right.
and an addition, it was a
small bedroom or something.
Right, and Santa Ana didn't require the permits,
Correct.
and they were okay with it, but it was the way, with the issues we were having was the way the work was completed.
Right, it was like a guy who I think did it overnight with some water.
Yeah,
So
literally.
it depends on the quality of the work as
Blocked
well.
the garage
Yeah,
door
yeah.
with a wall,
Yeah.
but left the garage door there.
Right. Yeah. Yes.
With the typical like HUD repair list that they'll go through on a regular FHA, what if they, what are you doing on a reverse and holding back funds for that?
Yeah.
Appraiser follow
Sure.
up to time frame to make sure.
Right, so health and safety issues as far as repairs have to be addressed prior to closing. So the broken windows, staircase that doesn't have railings on it, broken staircase. We had a deck that didn't have a railing on it that was too high, needed a railing on it. So there's no exceptions on those. You have to get those fixed beforehand. The other types of things, unfinished floor. So it's there, it's safe, it's good, it just doesn't have a finish to it. We would set aside for that. So we could either use the appraiser's estimate, or it's really preferred to use a contractor's estimate, because then we can set aside less money. It's only 1.5 times the contractor estimate. It's 2 times the appraiser's estimate. So that's where some of those set-asides can kick in, and that gets set aside from the loan. And on the statement that the borrower gets, it'll show that there's some funds set aside. When that work is complete, a 1004D is done, appraiser goes out, does the inspection with the servicer, shows that it's done, funds are released.
What
So
about
that's
for the more minor stuff that FHA would typically get involved, peeling paint, that kind of stuff?
all the same stuff. So in other words, depends on area. So peeling paint, we've had some that's been sort of up north in the winter. We did set aside. It wasn't going to be able to work in the winter. If it was summer, we had to address it. Cracks in the wood, rotted wood, those kinds of things.
I was
Yeah.
gonna say, most peeling paint can be done post-closing, unless it, lead-based paint has to be taken care of. Beforehand, if it's a danger, you have children in the house, that kind of thing. Most things can be done as a repair set-aside. The only issues you're gonna have are the health and safety, or active leaks. If there's a problem with the roof, then there's a hole, No, don't laugh, it happens all the time.
Yeah.
Those types of things have to be done prior to. But generally, it's very flexible with the repair set aside.
And we work with some national sort of contractors who sub out to contractors around the country who can help send someone out pretty quickly to assess the situation, get us some quotes at what it might cost to fix it, get us some letters to state the roof is okay, it has a few years life expectancy yet, the peeling paint has been fixed, the leak has been repaired, etc. So we work with people who can help get that addressed pretty quickly, either in a set aside or to do the work immediately. Yes, sir, in the back there, yeah.
Two questions. So the appraisal, is it going to be the same cost as an FHA, $500 for the appraisal?
Yeah.
Okay, and then.
Depending on the AMC, it could vary a little bit, but yes, it's the
What
same.
about if there's renters in the property? Are they going to be able to do a active loan with a renter in the property?
Well,
Well, it depends.
it depends. Is it a multifamily property?
Well, let's say they have a granny unit in the back.
Okay, so accessory units, if it's an accessory unit, a legal accessory unit, no, you cannot rent accessory units. If it's a legal multifamily, so a 2 to 4 family, absolutely, as long as your borrower lives in the predominant unit. They can't live in the tiny little basement corner apartment. They have to live in one of the larger units. Accessory units are not permitted to be rented. They're intended for family members, guest houses, that type of thing.
Okay.
Yes.
I'm still confused on the maximum loan amount.
Yep.
I initially had the understanding or thought that if the maximum loan amount is $625, and let's say you, by age, can get the maximum LTV, that might be able to allow you to purchase property for maybe $1 million. But now I've been
Let me simplify.
indicated that it's the maximum loan amount $625, which is the maximum principal limit, which then you apply LTV to, which
Yeah.
ends up being somewhere around $350,000.
So the max claim, which is a fancy word for the appraised value, which is the limit, which is 625.5, okay? Your loan to values, we don't really use the term loan to values in reverses, okay? We call it principal limit utilization, PLU percentages, but for purposes of this crowd, and to be honest, most crowds, even like our own loan officers, what's the LTV? How much can I borrow? It's going to range from 52 to 75% depending on age, okay? So as that age changes, again, every 6 months it changes as they get closer to the next birthday.